Grinnell Capital is a boutique asset management firm based in Park City, Utah.
Good morning. My name is Frank Grinnell. I've been investing in the stock market for over 20 years. It serves as my day job, and most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we share high-conviction ideas with subscribers, and we actively manage stock and ETF models for financial professionals and their clients, as well as individual investors. For more information, check out our website. Before we get to today's podcast, be sure to hit subscribe. And now, today's Street Views. Hey, good morning. Welcome to Tuesday, 6th of December, 2022. All right, yesterday wasn't all that fun. Kind of keep you on your toes, remind you that we really are probably still in a bear market. One thing I did neglect to say yesterday, Mike Wilson out of Morgan Stanley, who's been spot on, calling the bear market at 22, calling the rally from October 13th. The guy's had a pretty hot hand. He did come out yesterday morning and restate his bearish posturing. So no more rally for him. He thinks we start trading lower again from here. And he's looking for 3,000 to 3,300 on the S&P, which I can show you over here on the graph. I got this SPY up. That takes us down to, this sort of range here, which would be obviously pretty far below the lows we've made this year, and a significant drawdown from current levels. So while that's not out of the realm of possibility, I think that one of the things that can almost get you thinking that direction would be if, in fact, the Federal Reserve is over tightening. We've got here, I'll show you this. I got a chart that I want to point out real quick. You look at money supply versus CPI. This came out of Zero Hedge yesterday. They're looking at CPI over versus M2 money supply. I'm not sure what the 16-month lead on the M2 is, but that's what it is. On a year-over-year basis, you could tell where the money supply has gone, and the thought is CPI has a pretty tight correlation. Kind of makes sense. So then you go and think maybe perhaps if money supply is already down here, the idea of over tightening by the Federal Reserve should be on your mind, should be a scenario of possibility. And that would probably mean if things do really start to fall apart, the December hike will probably be the last one, if in fact this is the case. So what do you get in correlation with an over tightening Fed? Obviously, you got a real risk of recession. You've got a possibility of probably deflation happening in the back half of 23. If you look at Treasuries, pull up the TLT, this would all be in favor of long Treasuries, in my opinion. Flight to safety, plus if you've got money supply dipping that low, you've got growth no doubt following, and you've got a dollar that's going to head lower as well as yields also go down. Flight to safety into Treasuries. I think that is a pretty bullish case for Treasuries here and now. Is that risk of deflation? Is that risk of over tightening by the Federal Reserve? So TLT, we talked about that one before. Looks interesting. We use SCHR. We're on Schwab. This is free for us. This is a 10-year proxy. We've got both those in place. Could be adding to the TLT over the not too distant future. The other thing that looks interesting today is, emerging markets. So if you think about weaker dollar, you think about valuation, and you think about an economy that's actually still stimulative rather than throwing headwinds at their economy as our central bank is. China comes to mind. The EWH, we've talked about that a lot. Hong Kong, it's looking up 2% this morning, 2087. It'll open above this 200-day moving average a little bit. The 200-day is right at 2074. So that trend still continues. We also own, we've talked about this, the ECNS. And the small caps in China, that'll probably be up today as well, if I had to guess. And then I want to talk about another emerging market, but I'll save it till tomorrow. But I also want to talk about oil. I mentioned yesterday, it is a mess. This is a do not touch in terms of adding new capital, as far as I'm concerned, until this thing just settles out a little bit. For whatever reason, nat gas and oil want to go lower, period. Factoring in global recession, whatever it is, doesn't matter. The good news is it's so early in the cycle to think about. I mean, the things that end an oil run are rising capex to the point where you got too much capacity, kills price, whatever. We're not even sniffing that type of capex at this point. We're just getting going. So the cycle itself, I think, very well intact. The near-term risk is the pricing, I think, can go almost anywhere over the real near term, given the weakness that is perceived to be taking place in the first half of 23. And that's what I got. Good luck out there. Have fun. Talk to you tomorrow.
And now for some important disclaimers. This podcast is intended for financial professionals only. Grinnell Capital LLC is a state-registered investment advisor located in Utah. Services offered by Grinnell Capital can only be offered in the states of Utah, Idaho, California, and Texas, where Grinnell Capital is registered or where otherwise legally permitted. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisor.info.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be consumed, construed at the provision of personalized advice, and is subject to change without notice. This material should not be considered a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital LLC as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility. Therefore, this podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve long relative and risk-adjusted returns, primarily by investing and trading securities issued by companies that focus on the global information technology, consumer healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth potential and an abundance of both new and maturing product cycles, a field of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange traded fund, ETF strategy, with an investment objective similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some risk aversion in the event of significant market stress through investments and ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital LLC has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, www.grinnellcapital.com.